Welcome back to the channel. In a quarter where many energy giants have faced headwinds, Chevron has just dropped a blockbuster earnings report that beat expectations across the board, and the market is loving it. Today, we're breaking down Chevron's stellar third quarter 2025 results, explaining why the stock is popping, and most importantly, what it means for investors going forward. Let's dive in. Chevron Corporation is a leading American multinational energy corporation, one of the successor companies of Standard Oil, and is now fully integrated across the oil and gas industry. Its core business encompasses upstream operations, which include the exploration, development, and production of crude oil and natural gas across the globe, and downstream operations, which involve refining, marketing, and transporting petroleum products like gasoline, diesel, and lubricants. Additionally, Chevron is active in the chemicals industry and is increasingly investing in lower carbon energy sources such as renewable fuels, hydrogen, and carbon capture as part of its evolving energy transition strategy. As one of the world's largest publicly traded oil and gas companies, Chevron's financial performance and market position are heavily influenced by global commodity prices, geopolitical events, and the long-term global shift in energy demand. First, let's get straight to the headline numbers. The bottom line? Chevron delivered a clean sweep. Earnings per share. They reported an adjusted EPS of $1.85. That might not sound huge, but it solidly beat Wall Street's forecast of $1.75. Revenue? They brought in a massive $49.73 billion in revenue, also cruising past expectations. Stock reaction? As you'd expect, the market responded positively, with shares up over 2.5% in pre-market trading.
So, what's fueling this strong performance? It boils down to two major factors. Number one, record-breaking production. Thanks largely to its massive $55 billion acquisition of Hess Corporation, Chevron hit a monumental milestone, pumping over 4 million barrels of oil equivalent per day. That's a record for the company, with huge contributions from the Permian Basin, the Gulf of Mexico, and Kazakhstan. The Hess deal isn't just a line on a balance sheet, it's actively supercharging their output. And number two, improved refining margins. While the upstream side of getting oil out of the ground saw some pressure from lower prices, the downstream business of refining and selling fuels saw much healthier profits. This diversification helped cushion the blow from volatile crude prices. Now, let's talk about what really gets investors excited: cash and shareholder returns. And here, Chevron is absolutely delivering. Cash flow. The company generated a whopping $9.9 billion in cash from operations, a 20% jump from last year, even with lower oil prices. That's a sign of incredible efficiency. Free cash flow. After accounting for various items, adjusted free cash flow was a robust $7 billion. Returning cash to shareholders. And here's the best part for investors. Chevron is putting that money directly back into their pockets, announcing a $6 billion cash return through dividends and buybacks. This commitment to shareholders is a core part of their strategy. But a great company isn't just about what it did last quarter. It's about where it's going. So what is Chevron's guidance and future outlook? CEO Mike Wirth emphasized their focus on affordable and reliable energy, while also driving efficiency. In fact, they're rolling out a new operating model expected to save them $1.5 billion annually. Looking ahead, Chevron expects full-year production growth at the high end of its 6 to 8% range, capital discipline with organic spending guided between $17 and $17.5 billion. And they're not ignoring the future, making progress on green hydrogen and other strategic projects to diversify their energy portfolio.
Let's talk about the bull case, the reasons to be optimistic about Chevron. Point 1. Operational powerhouse. Chevron isn't just treading water, it's hitting record production levels, now exceeding 4 million barrels of oil equivalent per day. A huge part of this is the massive acquisition of Hess, which significantly boosts their scale and future revenue potential. Point 2. Financial fortress. It's not just about pumping oil. Chevron is seeing improved refining margins, meaning they make more money turning crude into gasoline and other products. Combined with stronger natural gas prices, this provides a nice earnings cushion. Point 3. Efficiency and innovation. The company is on a major cost-cutting drive, with a new operating model expected to save a massive $1.5 billion annually. That flows straight to the bottom line. Plus, they're strategically investing in the future with projects like green hydrogen, positioning themselves for the energy transition. Point 4. The shareholder reward. This is a big one for income investors. Chevron generates robust cash flow and is famously shareholder-friendly. They return a huge amount of capital through reliable dividends and stock buybacks, which is a solid foundation for investor confidence. And right now, many analyst price targets are pointing to moderate upside from current levels. Now, let's flip the coin and look at the very real challenges and risks. Challenge 1. The oil price problem. This is the big one. Weaker crude oil prices compared to the peaks of recent years are putting direct pressure on Chevron's upstream earnings, which are expected to be down significantly year over year. Challenge 2. Volatility and macro headwinds. The entire sector is at the mercy of commodity price swings and broader economic uncertainty. OPEC's deduction decisions and shifting global demand add layers of complexity that are hard to predict. Challenge 3. Acquisition hangover. Integrating a giant like Hess isn't free or easy. There are significant costs and transitional expenses that could weigh on Chevron's near-term financial results. Challenge 4. A premium price. Despite these challenges, Chevron's stock often trades at a premium valuation compared to some of its industry peers. This could limit the near-term upside until the company clearly outperforms these expectations. Chevron presents a classic balance of strength versus circumstance. On one hand, you have a company with stellar operations, strong finances, and a proven commitment to rewarding its shareholders. On the other hand, it faces near-term pressure from weaker oil prices and the complex task of digesting a major acquisition.
Let's talk about Chevron's dividends because it's seriously impressive. This isn't just a company that pays dividends. It's a dividend aristocrat, an elite group of S&P 500 companies with a history of increasing dividends for at least 25 consecutive years. But Chevron doesn't just meet the standard, it smashes it. They have paid dividends for over 25 years without a single cut. More importantly, they have increased their dividend for 38 consecutive years. Think about that. That means Chevron, who's been raising its payout through multiple recessions, oil price crashes, and global economic shifts. That kind of track record doesn't happen by accident. It signals a company with incredible financial discipline and a core commitment to returning cash to shareholders. So what are you getting today? The current annual dividend is $6.84 per share. That translates to a very attractive dividend yield of about 4.4% as of late 2025, paid out every quarter. Now, let's address the elephant in the room, the payout ratio of around 85%. On the surface, that seems high, and for many companies it would be a red flag. But for Chevron, it's a different story. This high ratio is considered manageable because of Chevron's massive and stable cash flow. Even when oil and gas prices fluctuate, Chevron's scale and integrated operations generate enough cash to comfortably cover the dividend. Analyst services consistently rate Chevron's dividend safety as above average within the energy sector. The dividend isn't just a promise, it's backed by a fortress of cash flow. But safety is only part of the equation. What about growth? Chevron isn't a high-flying growth stock, and it doesn't pretend to be. Instead, it offers something just as valuable for income investors: predictability. Over the last 5 to 10 years, Chevron's average yearly dividend growth has been a steady and respectable 4.5% to 6.5%. Recently, they've been hiking at about 5 to 7% per year. This moderate, consistent growth helps your income outpace inflation and compounds your returns over time. It's a classic tortoise versus the hare approach that wins in the long run.
According to the latest data from Wall Street, the overall consensus rating for Chevron is a hold. Breaking that down, out of 23 analysts covering the stock, about 43%, or 10 analysts, have a buy rating, with one of those being a strong buy. 39%, or 9 analysts, are telling investors to hold on to their shares, and a smaller group, about 13%, or 3 analysts, are recommending you sell. So the picture is mixed. The largest single group is the bulls, but when you combine the holds and sells, they actually outnumber the buys. This tells us that the professional move is cautious. The message is, if you already own it, it's probably fine to keep it, but they're not aggressively telling new money to jump in. Now, what about price? Where do analysts think the stock is headed? The average 12-month price target for CVX sits at around $165.25. From the current price of about $156, that implies a potential upside of just over 6%. Not exactly a home run, but a solid, if modest, gain. But here's where it gets interesting. The most optimistic analyst on the street has a price target of $197 per share. That represents a massive 27% upside from today's levels. This shows that there's a bullish case to be made, where Chevron could significantly outperform. The general recommendation is a neutral hold. However, there's a key strategy embedded in that rating. Many analysts suggest a buy-on-dips approach. This means they see more compelling value if the stock price pulls back from its current level, rather than buying right now. That's it for this analyst breakdown. Let us know in the comments below. Do you think Chevron is a hold, a buy, or a sell?